This is Agriculture Today, and I'm Shelby Varner with the K-State Radio Network. Glynn Tonsor, K-State livestock economist, begins today's show with a cattle market update. He explains the current state of the market and the weather's impact. He also defines demand destruction and what it means for the cattle market. Glynn also says what they will be specifically looking into for the meat demand monitor. Kansas Farm Management Association economist Jonie James keeps the show rolling as she discusses factors to consider with personal finances. She explains how people can financially be more prepared for life changes and what her budgeting tips are in this two-segment interview. That and more is coming up ahead. You're tuned in to Agriculture Today, and we start our Monday show with a cattle market update with K-State livestock economist Glynn Tonsor. Glynn, thanks for joining us today.
My pleasure, Shelby. Thanks for having me on.
Glynn, looking at the cattle market, first talking about cash cattle.
Yeah, so I'll overview the markets and then we'll give a weather update, which I'm not a weatherman, but it is prudent this week. So the cash cattle markets on Friday, USDA called the 5-area market at 197. I will note that's ending the year quite nicely. I'll give some context to that here in a minute when we look at the board. Flipping over feeder cattle, there was little to no reported activity by USDA this past week, and that's the holiday effect. Lots of auction barns were closed. But again, I will note particularly the fourth quarter of 2024 that's now complete ended with a very strong tone to it in the feeder cattle market. I think that reflected tightening supplies. Past guests, I'm sure, have talked about the situation in the Mexican border makes that even tighter. Who knows how long that's going to last here into 2025. But, to put a bow on the cash market, fed cattle was up, not much action in the feeder cattle market. And I expect this coming week to be kind of slow as well because of weather. So before I break down the rest, I'll just kind of remind folks, you and I do this and it's a rotating panel, folks are on every Monday. Most of our listeners are Kansas centric, but it does go on the web, right? So somebody might be listening to this that isn't within a couple hundred miles of I-70. And unless you lived under a rock, if you're anywhere near I-70 in the last 48 hours, there's been a pretty heavy amount of snow, ice, depending on where you're at, that's hit. We're now doing this on Monday morning, calling for a lot of cold temperatures next couple of days. My family resides, and I'm talking to you from St. George, Kansas, which is just a little bit east of Manhattan. The National Weather Service claims we got 18 inches of snow on Sunday here. This farm boy moved it yesterday, and I thought it was 15 inches. So hopefully my house is a little bit better. But the Kansas City airport reported 11 inches of snow just on Sunday. And what I read there was that's the fourth largest single day snowfall. So I'm belaboring this because the I-70 corridor took a hit on snow. The moisture part of that's good, but ice underneath it wasn't. And the cold the next couple of days is worth watching. I suspect that's going to have some implications on, logistics, grain coming in out of feed yards, cattle going to packing plants and so forth will be disrupted. Hopefully for just a day or two. Later, midweek, later in the week looks like normal. So we're talking on Monday. Hopefully by Wednesday, things look normal. But I want to add that on as, I said we have this pause in the cash market because of holidays. I think weather is going to add to that pause is the point. Continue this out. So CME contracts, we closed last week, February live cattle 194, up about $5 from the week before and up about $20 since about Labor Day. March feeder cattle closed at 264, up about $4 or $5 for the week and up a full $35 since Labor Day. So again, regardless of weight class, we had this nice run up in the value of cattle as we concluded 2024. And then box beef, USDA called the choice market 325 on Friday, up about $3 for the week, and select at 297, up about $6 for the week.
So Glynn, starting 2025 on a fairly high note?
Yes. And, I'll look forward into 2025 a little broader here, but to put, let's look backwards for a moment. I think the tighter supply of cattle hooves, and yet the ability of the market to absorb more beef than we expected. And this is where animals and beef aren't the same is really important to appreciate. Is in 2024, we put more pounds on every animal leaving the feed yard than most analysts expected. That was the story, Q2 through the end of the year, really. And the ability of the market to absorb that without depressing prices, to me, is a strong testament to demand was, stable, if not strong, depending on what month we talk about it, what cut. That is great news going into 2025. I recently wrote a piece for the In the Cattle Market series that LMIC, tees up. And I try to give some context around the importance of demand, how it fits into that 2025 picture.
What was included in that publication, Glenn?
Yeah, so I'm doing the shout out here to raise people's awareness to that because I like the fact that LMIC puts that out weekly. I've been on that author circuit in the past. There's 4 to 6 of us that write it, so you don't hear from Glenn every week, and I think that's healthy for readers to get different perspective. But it's a nice synthesis of what we think is going on in the market. And I was scheduled to write the one for December 23rd. It's the last thing I wrote before trying to turn off this computer for a day before Christmas. And what I did was give some context to the cattle on feed report, which came out with not big surprises, as noted in the last interview you did. Transition over into the next major report will be the January cattle inventory report. So the very end of January, we're expecting USDA NASS to put out estimates that tell us, the total national beef cow herd size, some of that by state, heifer retention insights, and so forth. What I noted in that piece was I think it's going to say we started 2025 with even fewer mama cows than we did 2024. So not only have we not started expansion, I think we liquidated a little bit more, maybe 1% fewer cows to start the year, which to me tells me, by definition, if that's true, we haven't started expansion. And it'll be the summer of 2026 in my mind before that gets started in any real nationally relevant context. And then I transition in here to this term demand destruction. I hear the term off and on, and I think we're going to hear it more the next, 24, maybe even 48 months. And it gets confused is the reason I'm bringing it up, is people use that term because they think just because beef prices are going up, we're destroying demand. Economists like me get a little bit upset when we do that because we're confounding the terms of, per capita consumption per person, and demand when we do that. The role of price is to allocate scarce resources. And as we've shrunk the herd, we're in the process of probably producing less beef the next couple of years. And the industry should actually be cheering for higher retail beef prices, because if we don't accomplish that when there's less beef on the market, then I'm going to have to tell the world that beef demand fell. So when you have lower supply, if demand is stable, if not growing, we expect prices to go up. That's what we should be cheering for. And I was trying to give some words of caution around the term of demand destruction a little bit proactively, because I think that theme is going to be pretty strong as we go through 2025.
What is the potential economic health for the industry?
Yeah, so that's a good question. It probably differs by segment. So there's a lot of interest in the cow-calf sector about if, when, and how much will we expand the herd, as I alluded to. I think the health of the quote-unquote typical or average, whatever that means in the cow-calf sector, because it's a wide, diverse group, is a lot healthier today. You and I talking early January of 2025 than it was 2 years ago and 4 years ago. A couple of years of strong calf prices. On balance, we've produced a calf crop that was sort of expected. So we didn't have major drought, in the last couple of years that forced big changes there, nationally speaking. I think the health is better than it has been for that segment. The stocker and the feedlot and the packing segments all are facing the realities of lower hoof count. So those smaller calf crops lead to lower utilization. So we have physical capacity in all those margin-based stages that can't operate fully and optimally if we don't have enough cattle to do it. And that is squeezing margins. So I wouldn't necessarily call them unhealthy, but the health of those segments isn't as strong as it is cow-calf sitting here today.
So, Glenn, think it'll be a while still till we've reached that capacity and having optimal utilization of different services?
Yes, and it's not a new statement that I've been saying we have quote-unquote excess capacity in those different segments. It was an anomaly early in the pandemic that the packing sector had too many cattle to process. Before 2016, we had multiple decades to where we had more packing capacity than we had cattle. So that's not a new statement. On balance, I'd say the same nationally for the feedlot, more bunk space than we need. Think of it that way. The stocker and background segment's a little harder to peg because people do that on wheat pasture and so forth. So what's the nature of that capacity is a little harder to speak to. But I do think we're at least 3, if not 5 years away from getting a little closer to right sizing those capacity numbers with the cattle herd.
What's another report that people could be expecting to see from you here soon?
I alluded to demand. Most of your listeners know I spend a lot of my time trying to track and monitor both domestic and foreign demand for U.S. beef and pork and other meat products. The meat demand monitor, the December numbers are in. They're under review due to holiday effect. It's not public yet. You and I are talking on Monday. I think by Wednesday it will be posted. I will simply reiterate, that tells us that we ended 2024 with domestic meat demand good. I'm able to say that here. More details will come out later. We look forward to renewing that project. The beef checkoff funding is up for renewal here in 2025. Pork checkoff is already in place. So shout out to the pork side, shout out to the pending part of that for beef. That project's almost 5 years in the running. takes a lot of my time, but hopefully it adds value to your listeners here and all the stakeholders that pull it up. One nugget, just to kind of put a bow on this for 2025, you probably have heard about GLP-1s or Ozempic, Mounjaro, those kind of things are in the news, diabetes, weight loss, medications. I am not an expert in those at all, but some estimates say 10 to 15% of our country is either on them or been on them recently. And we have a country of over 300 million people, so that's a sizable, number of folks. One of the things we're watching in the meat demand monitor now is how does that relate to your consumption and your demand for meat? It's a shout out to Justin Bina, who's now at Arizona State University, former PhD student here, has an interest in that space. We're doing some related research. And I think here early in 2025, one of the probably hot topic things that you may not have expected coming, but I think is relevant from the MDM is some insights on that. Let's call it trend. I don't want to use the term fags. I don't know where it's going, but what are the implications of that new medical product and its fairly heavy adoption on the domestic meat sector?
And as always, Glenn, where can people find your meat demand monitor?
Yeah, so everything we alluded to today is cross-linked on our AgManager.info website. And if you're fairly new to this broadcast, it's our K-State AgEcon resource. You can find links to everything from the MDM, links to the in the cattle markets. If you go there and you find the tab called contributors, scroll down to Tonsor, or I usually joke, Google bald-headed economist, you'll find me, Shelby, and everything you will find that way. I hope folks do that because a lot of stuff we're sharing here is kind of time-stamped. It might be different in a week or a month, but it gets updated. So please go there and make use of those resources.
Glenn, I appreciate you taking the time to join us today and give us our cattle market update.
Thanks for having me on, and Happy New Year, everybody.
That was K-State livestock economist Glynn Tonsor. I will link the resource that he mentioned in today's show notes on agtoday.net. We're cutting to a short break now, but we'll be right back. You're tuned in to Agriculture Today, and we continue our show talking about personal finances with K-State Farm Management Association economist Jonie James. Jonie, thanks for joining us today.
Happy to be here.
Jonie, quite often on Agriculture Today, we talk about farm income, farm finances, but wanting to really take a look on the personal family finance side of things, and why is it important to look into them and set a budget?
When I think about the value in setting that personal budget, I think it primarily provides you a roadmap to your future. And we all do better when we actually have a plan. So budgeting helps us understand where our money is going each month. And then when we look at that as a clear picture of our income and our expenses, we are really better able to make that informed decision about spending and about saving. So a budget is really that foundation for achieving our short-term and our long-term financial goals.
What are some things to consider when people are looking into creating a budget?
Well, before we create our budget, we definitely need to come together and have conversations together because it's not one person's budget necessarily if we're thinking a family budget. So it's important to identify what we are hoping to achieve. We consider it as that map to arrive at a chosen place on our financial journey. And without that clear destination, we can really get sidetracked. So I would encourage people to really start by asking yourself and maybe your family members some key questions, like what are your short-term goals? And that's going to be different in every different stage of life that we're in. But this could include things like paying off debt, saving for a new car, or creating that emergency fund. And then we also need to consider what are our long-term goals, because we don't want to get so focused on the here and now that we fail to plan for the future. So what are those long-term goals? We think about retirement savings plans, possibly buying a home, helping to fund our children's education, things like that can be further long-term, but we need to plan for them while we are still managing our current situation. So then, as a family, or even just as an individual, you need to determine how you're going to prioritize those goals. And I would say we need to write them down. This makes them much more tangible and motivates us to work to achieve them. Just like with anything, it becomes real when you see it actually out there in front of you on a piece of paper or as a chart to try to achieve. So we analyze our income. We use our net income after taxes as actually will give you the most accurate picture of what you have to work with to meet those goals. And then we're going to have to track our expenses. And that's the part not everybody likes to do, but it's necessary to do. We really need to see where is our money going and what is it going for, and take a really close look at our spending habits and be honest with ourselves on those spending habits. And once we understand that, we understand what are our goals, what income do I have to work with, what expenses do I have to deal with, we can actually start to put together a budget. And the goal being that we'll have that money left over at the end of each pay period to put towards savings or reaching those goals that we identified earlier. Now, sometimes our expenses are more than our income. And so we actually have to be real, I guess, and identify that and address it. We have to look back at whether we cut back on variable expenses, and some of those might be some of our subscriptions to the different things that we do, maybe dining out, gifts given, things like that. We might have to sharpen our pencil when we shop. And there are some ways we can even negotiate with creditors to collaborate bills, to work on getting them paid off in a way. And oftentimes it's better to work with those creditors directly instead of just ignoring those bills, not opening them, that sort of thing. Instead, get a payment plan. And then if those things don't bring our income and our expenses in line, then we maybe need to look at adding additional income.
Jonie, what have been some things that you've seen or as you've talked with farmers or producers have really made impacts on the budget and the personal level?
Well, as I think about following the COVID period or coming back in 2021, farm income was at its record high and people were getting back to work and different things. But since then to 2023, we have seen a 9.8% increase in family living expenses. And that is significant. That is almost 10% increase in family living expenses. And at least on the farm income, we had a high in 2021, but we have seen it can go the opposite the last 2 years. And I suspect we will also see a farm decrease in 2024. And if you're just a wage earner, a W-2 wage earner, I don't think we have seen 10% increases in our wages. So I believe families are really starting to feel the pressure of decreased income coming in and yet higher family living expenses just to meet our everyday needs and goals. So that is a serious factor out there that I think is putting a lot of families under stress and anxiety, and that we need to address.
Wanting to talk through some different life changes today, and one of those possibly being combining finances with a significant other.
Right, that's one of those life expectations or changes that sometimes I hear young couples tell me they think they're going to actually save money because they're going to do some things together. And in reality, it doesn't work out that way. It usually gets more expensive as we have these life changes and these wonderful events that happen to us. And mainly that's suddenly because we're caring about somebody else than just ourselves. And so our goals change. We need to begin to plan for things such as maybe life insurance to care for that spouse if something happens to us. Increased health insurance premiums. Single plans are much more affordable than when you are carrying an insurance plan that also covers a spouse. We also need to start to have goals, potentially looking at purchasing a house, saving for future goals, possibly having children, things like that.
And another milestone that you mentioned, having a child, and what are some things that people should take into consideration in their finances when that milestone comes?
So definitely adding children it does stretch our budget, but there's definitely some decisions that we need to think about how to address, because once we have these children, someone's going to maybe choose to stay home and be the primary caregiver for those children. So we may need to make some adjustments in our budget for a reduction in income due to that parent staying home. Or we may need to make an adjustment to that budget in the fact that we need to now budget in childcare expenses, which have also extremely gone up. Just the ability to find good childcare and the affordability of childcare we've seen increase significantly since 2021 as well. So we need to budget for those things. Other things we need to think about if we do begin to add children is we need to talk to our HR department if we have off-farm income, because oftentimes there are some programs that help us use our money tax-free to pay for childcare, to have flexible spending accounts that help pay for some of the health costs that might go along with bringing in that family member. And so we need to definitely investigate that if that's not something you're aware of what your company offers. So definitely look at those things. Health insurance is, one of the most expensive expenses that affects many family budgets. And so adding children to that plan is a significant increase in those premium costs, and we need to include that in that budget planning process as well. We need to look at things and look at the different avenues. We need to look at the different strategies to cover those costs and evaluate the different options we have, because there are options that need to be looked at and available to in different situations.
And Jonie, also while we're thinking about children, maybe wanting to plan ahead for their education.
Yes, there's really one underutilized strategy I think parents should really consider when we think about planning for our children's education. I know we always encourage budgeting for saving and putting those in, but many of the families I work with, own their own business. They operate their own farm, but also many of them operate businesses outside of farming and could use this strategy as well. And that is when you actually employ your children to do work within that business. The employment does need to be for actual work. It needs to be a job that is legit within the business. But when we employ our children, especially those under the age of 17, parents are not required to pay in any FICA taxes on their wages. Now, if your business happens to be an entity or something, then they are. But that is one of the benefits if you're a sole proprietor and you have a business and you employ your child that's under the age of 17, you're not required to pay in those Social Security taxes. Now, the children now have earned income regardless. And that earned income makes them eligible to contribute that to a Roth IRA. And that Roth IRA can then grow and earn income and then be withdrawn to help fund that child's education. So you've been able to employ them and expense that for that legit work, that work opportunity, and they're able to invest it and it grow and then withdraw it and use it to fund that. So I think that's one of those strategies that often is missed, a missed opportunity for them to do. So something to think about.
What about when we think about retirement?
Start early. I'm actually surprised at how many tax returns I do for young, early out of high school or early out of college, their first job, and they're missing participating in their retirement plan because some employers out there make it optional, or optional when they start, or optional to how much they participate. And now I really want to encourage people to start early because it's much easier to move that money out and get it designated to your retirement before you ever have access to spend it. So it's a great, if you've never had it, you don't miss it. And so start early, really utilize those employer plans to the full extent possible.
That was KFMA economist Jonie James. We're cutting to a short break, but when we come back, we'll once again be joined by Jonie as we conclude our conversation. You're tuned in to Agriculture Today, and we continue our show and conversation on personal finances with Kansas Farm Management Association economist from Kansas State University, Jonie James. Jonie, we ended our previous segment talking about retirement, which people can find on agtoday.net. However, as we continue our conversation on retirement, what are some other options that people might want to look into utilizing to be set up for their future?
And then I would even encourage you to consider budgeting for voluntary retirement plans as well. So even though you participate in your employer's plan, you still have the opportunity to fund Roth IRAs or individual IRAs or even other investment opportunities to different limits depending on age and income levels and different things. But it's definitely worth participating in those. If you are a self-employed individual, really encourage people not to skip investing each year in their SEP or their traditional or Roth IRAs, because at some point they are going to retire, even though they really think that's far off into the future. But if we don't have a plan for that retirement, then we're going to rely too heavily on either the farm business or some other source to fund that retirement. So start early. And then when we do retire, we really need to consider where's our cash flow going to come from? So we think about that, where it's going to come from, and what we decided much earlier in our life has a real effect on where is that cash flow coming from. So it's really a misconception to think you're going to be able to live for less. So having multiple sources of funds is ideal. If we're relying on our Social Security, our retirement that we've invested in, whether that's a SEP, IRAs, 401k, whatever our options are, and then also whatever asset we maybe have also grown as a business, whether it's a farm or a small town business, on Main Street. Pulling in that different revenue is our cash flow that's going to fund that retirement that we're going to want so that we have the retirement that we want. It's also real important as we get closer to that period to evaluate what level of risk do we have out there on our investments and how balanced is our portfolio, because we know the stock market dips and change, and so you want to make sure you're well balanced so different times you can pull from different types of funds to help manage through those more challenging times out there in the stock market. And I do want to make a note or point this out, that government pension plans are used by many. I mean, they're part of what we often have as a retirement option in our employment. But I want people to understand how those pensions work. And so what they receive as a monthly income from that pension stays fixed. And so they get that same amount every month. And that may be enough to meet your financial needs today and maybe for the next 5 or 6 years into the future. However, we're all pretty much living longer. And so that amount may not be enough 15 years into the future. And so once again, having those multiple avenues of cash flow to fund that revenue or your retirement is pretty important. And just for example, one of those pension plans that so many people in the state of Kansas use is Capers. That's almost every teacher, educator, many of our other businesses. So that's one of those fixed plans that we need to maybe not rely just solely on that being our only form of retirement.
Jonie, I appreciate you taking the time to join us today and have us think through some personal finance things.
Thank you. I think, taken away, I think if you can develop that family budget, it's really a strong step in having a strong financial well-being. The process helps you set goals, track spending, helps you make those informed decisions. And a common saying that I do believe works is that, if you plan for emergencies and you plan for the future, you'll actually experience fewer emergencies in your future. And I think that's true. The more time you invest in the planning for not just the here and now, but for what you want your future to be, helps you mitigate the challenges like what we're seeing right now with those increased financial family living expenses, and helps us mitigate through that. So thank you, Shelby, for the opportunity to share my thoughts.
Absolutely. That was Kansas Farm Management Association economist Jonie James. We're cutting to a short break now on Agriculture Today, but we'll be right back.